worlds, welcome back to Business Thursday. So glad you're here. If you'll remember from last week, this is my best friend Allie from college.
Hey.
And I'm visiting her out here in LA because she works for Investors Business Daily out here. And if you'll remember from last time, she told us a little bit about herself and then also who an investor is. And this week we're going to talk about what an investor does in more detail. So could you tell us some more about that, Allie?
Exactly. So the two main ways that investors supply capital to businesses in the financial markets are through stocks and bonds. So a bond is money that you give to a business, and at a designated point in time in the future, they pay you back, and it's a fixed payment. You know what you're signing up for. So say you have $1,000 bond. I know it's a lot of money, so we're talking about big adult companies in this situation. So you have $1,000 bond, and then in the future, this business, in this example, agrees to give you $1,100 in return in 1 year. So you get to make $100, and they get to use that $1,000 to improve their business. And yeah.
That's cool. So that kind of reminds me of an example that we talked about for the dog walking business that we've been doing through this series.
Yeah, that's great.
Yeah, where so if maybe I needed to buy a whole bunch of equipment or leashes, I would get a loan from my parents.
Exactly.
And that we'd have a designated date in which I would have to pay them back and pay them back with interest, which I guess is that extra $100, right? So the business pays back.
Exactly.
Okay, cool.
Yeah. Just like at a bank, if you or your parents, for the loan, in order for you or this business to receive this amount of money, to get that luxury, you have to pay them back a little bit more, so it's worth it for that other party to give you the money.
Yeah. So I wouldn't want to get rid of $1,000 for no reason.
Exactly.
I would want to make sure that I was going to earn some money back for that, right?
Exactly.
Okay, cool. And so the second way that investors can invest their capital to help businesses grow is through stocks, right?
Yes.
Okay.
The stock market, it's kind of like a slice of pizza in a way, which we're going to use for our example. So
doesn't it look delicious?
Yes. So this pizza represents a pizza company.
Okay.
So they have to buy the dough and the sauce and the cheese, the pepperonis. They have to have ovens. They have to have people to cook the pizzas. They have to have pizza boxes.
A lot of things to get pizza.
A lot of things. A lot of things. So this is a pizza company.
Okay.
And this slice of pizza is like a share of ownership in the company, which we call a stock. So the pizza company issues an initial public offering. So they make a public announcement to the public, and they offer these shares for a certain price.
Okay.
Exactly. So say...
And why would they do that?
Because they need money from investors to improve the success of their business, to buy more dough, to get more cheese, to hire more workers, to open up more locations, to improve the quality of their products. Maybe even they need more advertising to let people know how great their pizza tastes.
Okay, that makes sense. So they need more money in order to pay for those business costs or expenses.
Exactly.
Okay.
Right. And so people who do their research about this pizza company will find out whether or not it is a sound investment, meaning it's a good investment, meaning it's worth your money to buy a share of stock ownership in the company because you think that this company is going to be successful.
Okay. So let's say I researched this pizza company and I thought they were going to become even more successful in the future than they are now. And I want to buy, if I want to be involved, I want to buy a piece of this pizza.
Exactly.
Or a share of this pizza company.
Exactly.
Okay.
So it's mutually beneficial in that this pizza company gets your $2 for you to have a share of ownership of the company, which affects the people who run the business because they have other people who have a piece of the pie. So they have ownership.
Okay.
And so it encourages and incentivizes the business owners to run their company very well and to be successful, so that it's not just your $2 that you're putting in for nothing, like Carissa was saying earlier.
Okay.
It's for your benefit.
Great. So how do I benefit after I bought my share of this pizza company for $2, which I've done, a $2 pizza
Yes.
business. So how do I benefit from this later on?
Exactly. So then what investors do is what we call go to the secondary market, which is where investors trade stocks with other investors, buying and selling. So Carissa has this piece of stock, this share of a company, and say this company is very successful. So now the value of this share that we're representing in the slice of pizza has gone up.
Okay.
It's now worth $3. Yeah.
That's great.
So, and I want to buy it now because I think that it could maybe even go up to $4.
Okay, great.
So Carissa is going to sell me this share. Yummy pizza.
There's a little bit of pizza company for you.
Yes, woohoo! So it's beneficial to her because Carissa just made $1.
I have $3. I spent $2, so now I have $1 extra, right?
Exactly.
I did the math correctly.
Yes.
Good. I can add and subtract.
Exactly. And imagine if Carissa had bought 3 entire pizzas.
Word.
How many slices is that? That's a lot of dollars that you can rack up if you invest in a successful company. But remember, always do your research and be aware that there is risk involved, because a company, they may not buy the best cheese, or maybe the manager quits and it's just not run as well. So there are risks when you invest. But the reason why someone would buy a share from another investor is because they believe that they can even sell it to someone else for even more. So it's kind of like a chain. So Carissa buys it from the company, and then after that, investors can buy and sell the stocks from each other.
Okay.
And although the company only initially makes those $2, what we make after that, it's just between investors.
Okay.
But it still has an effect on the company because it is a measure of success. If it's worth $2, then $3, then $4, it's definitely a measure of success.
Awesome. So I guess the reason why investors would invest in the stock market is because they could make a lot of money from that.
Exactly.
But there's also risk involved, because maybe I only was able to sell my piece of the pizza company for $1 and I lost $1 on each share, right?
Exactly,
Okay.
exactly. So there are risks involved with the stock market. So maybe you like risk, so that is why you would invest in the stock market. But a sound investor, a good investor, would like to spread out their risk, meaning they will invest in different things. So maybe at the same time that you're investing in this pizza company, you can invest in a cupcake company.
Love cupcakes.
Exactly. So maybe if you lose $1 on your pizza when you sell it, maybe you'll gain $1 or $2 on your cupcake investment.
Cool.
Yeah.
Thank you so much, Allie, for explaining this to us. And next week, Allie's going to give us some more tips, like she just gave us some really good ones, about wise investing and how we can become investors and start making some money. And hey, if I can make money off of cupcakes and pizza, I can't wait to hear what else I can make money off of. Thanks so much.
Of course.
See you next week, girls.
Bye.
Bye. I'm going to have a piece of this now.
I know.